This is Business Weekend with Ross Greenwood.
Hi there and welcome to Business Weekend. I'm Ross Greenwood. It's great to have your company today. Coming up on the program, we're going to hear from Australia's most senior chief executives with tales of expansion, of loss and even of thievery. And we'll wrap up the profit reporting season where any small miss or victory was greeted with massive spikes up or down in share prices. June Bailu will be with us very shortly.
This is something only happened to tiny micro-cap companies rather than the large blue-chip companies. It's very, very unusual.
Now, one chief executive who's weathered plenty of reputational issues since she got the top job is the Qantas chief executive, Vanessa Hudson. Despite a record $90 million penalty against the airline for illegally sacking 1,800 workers, Qantas revenue and profits soared in the past year, with significant expansions planned.
Results, and the financial performance of these aircraft are delivering results. So that's a win-win-win.
And this week, Australia Post took the extraordinary step of cancelling the shipment of small parcels worth less than $800 US to America. The reason is new US tariff laws that apply charges on all parcels and not just those worth more than $800. Late this week, Auspost Chief Executive Paul Graham explained to me why he had to make that tough decision.
If we hadn't made that decision, that would have meant that products would have been shipped to the US and then the duties and taxes would have been applied, which may have been a financial surprise.
Also today, we'll speak with Medibank Chief Executive David Koskar and the Coles Chief Executive Leah Workat. But I want to start with lessons from the past month's profit reporting season. Look, there are plenty of them. For chief executives and investors, there's one clear standout. Miss your profit forecast and your shares will get smashed. It doesn't matter if you're the biggest companies in town, the Commonwealth Bank or CSL, or the smallest, Nuix or HMC Capital. The story's the same. Miss your profit estimates, suffer the consequences. And the share price swings in the past month have been more violent in both directions than ever before. The other lesson from the reporting season is the outlook for future growth is more important than in the past. In the past month, Ed Boyd and I have interviewed more than 30 chief executives of Australian companies. Most of them are large businesses that have broad shareholder bases like the Commonwealth Bank, BHP, Woolworths, Woodside, Qantas, Fortescue and Medibank. Others are astonishing growth stories, like the medical imagery storage business Pro Medicus, which has a market value of $32 billion, but only 132 employees. And the Aussie-based gold miner Perseus, now developing its fourth gold mine, but every one of them in Africa. Well, late this week, I picked out some key themes that I gleaned from conversations with these CEOs. One of them is the big swing in share prices, but other themes include the difficulty caused by high energy prices. Another is Australia's flagging competitiveness, which means more large multinational companies are devoting more of their business and capital to foreign markets and not to Australia. To this end, government has to be constantly mindful about Australia's competitiveness and not to be complacent that we, the lucky country, will always be so. We now compete with far larger nations with bigger resources for capital, for jobs and for future tax revenue. But all that said, there are brighter signs for our economy. Consumer demand slowly seems to be coming back to life, with rate cuts and tax cuts helping. Housing markets likewise are reviving after 2 slow years, and that's good news. The cost of living crisis for more families will abate. And that's music to the ear of experienced retailers like Jerry Harvey, who spoke to Ed Boyd late this week.
Our sales of mobile phones are going like this. Our sales of computers are going like that. And it's having this great rub-off on the rest of our product category. So when people say to me, how are your lounge sales? How are your bedding sales? How are your fridge sales? I said, well, they're pretty good. They're all pretty good. How are your AI sales? They're better than all of that. So, but when you go across the board, you're looking at good sales increases in all these stores all across the world. We've got 305 shops in the world. Every one of them has got an increase on last year. This is very, very good for us. We're very fortunate.
Well, at the beginning of this results season, we spoke to June Bailu, founder and investment manager at 10Cap. At the time, she told us that companies that missed their forecasts in this period would be punished severely by the stock market. She was right. She also flagged a shift into cyclical stocks, especially those related to housing. Have a listen.
So the retail companies, so your JB Hi-Fi, I know it's done really well, but you should really pay attention to the leverage in the next 12 months. I still think analysts will be undercooking it. And I think the furniture companies are interesting, because the housing turnover hasn't got a pickup yet, but we see the housing prices. Every auction is being very, very strong. So you want to buy the housing-linked companies. So, whether it's your realestate.com or it's your,
Nick Scali is another one.
Nick Scali, your Harvey Norman, some of those housing-related, and also some of the retirement living sort of businesses, because they are very much linked to the housing market as well.
Well, that was a month ago. June Bay Liu now joins me in the studio. June Bay, always good to chat.
Good to see you.
Okay,
Ross.
So you talked about some of those housing stocks. Harvey Norman did pretty well.
That's
you talked
right.
about REA Group did pretty well. So there's been some big moves, but we identified some of the big themes out of this results season. But the thing that really stands out is the massive increases and the massive falls that companies had if they either missed their profit, sort of expectations, or they exceeded them. That's something we've never seen before.
Oh, we've never seen it. It's certainly not for the large cap like this. This is something only happened to tiny micro cap companies rather than the large blue chip companies. It's very, very unusual. I think there's some discussion. Maybe it's down to the positioning leading up to it. That could be a big factor. And of course, a lot of passive fund, of course, is driving those volatilities.
Okay, but it started really with CSL. You could see when CSL came out, and CSL was something that's broadly held by a lot of people, big fund managers. But as soon as it missed, and it really didn't miss by a whole lot, and it was its outlook that said was going to be a bit tougher, it got completely hammered. And that took, at the time, the whole market down with it.
Oh, absolutely. Look, CSL is an interesting one. By June and early July, most of fund managers are looking for, or investors looking for, the next cheap thing that will rally away. So we looked at the CSL and thinking, oh, look, it actually looks pretty cheap. And, and then they are publicly talking about cost cutting. So surely the earning can't be any worse after so many downgrades. And then so share price actually rallied 15% in January. Now, we saw the opportunity to take some profit off the table. And then when the result come, and that was clearly very, very disappointing, what they have demonstrated, that actual core business is actually going backwards. That's nothing we've ever seen before. CSL is a growth company and cannot not grow. So we're seeing a lot of growth fund managers just sold that company down. They don't want to be there anymore.
Okay, so there was that, but then there was the Commonwealth Bank. The Commonwealth Bank, Australia's largest company, Australia's largest bank. We spoke to the chief executive, Matt Comyn. Now, the interesting thing about that was its share price was so high, literally the most expensive large bank in the world at the time. Yeah. So it got sold off big time. But, and I think we can show you this about the best performers over the past months, they are the National Australia Bank and Westpac, which both rose significantly because people got out of the Commonwealth Bank and simply bought other banks.
Oh, absolutely. So it's Commonwealth Bank. This is a typical example of this, the key theme of the reporting season. You're selling some expensive company and moving into the cheaper ones when the earnings actually okay in the cheaper one. So Commonwealth Bank was most, like you said, the most expensive in the world. And then the Westpac and NAB and others actually, not that expensive. And then they're actually doing a bit better than expected. Capital position a bit better, margins a bit better. We saw significant increase and rotation out of CBA and into those banks.
Okay, so that's what I'd call a rotation play for an investor or a funds manager. And even investors who are watching this have to be conscious of those types of plays because they're out there. But they're very short-term plays. You've actually got to do a bit of trading during these periods when there's so much volatility, don't you?
Yeah, this reporting season in particularly is the case. That you see all this value being crystallized very, very quickly. And if you don't capture it, it could be a reversal the next day. So there's just been a lot of significant disruption to prices. In a way, it's good for active investors. But otherwise, if you're passive, it's almost you want to stay out of the market in this sort of environment.
All right, but I want to put it to you another way. And that is, let's say, for example, is a company like James Hardie's a classic example in this. It missed, right? And it really hadn't informed the market that it was even likely. There was no profit warning earlier on. There was no real guidance, right? So this is where it became a big shock for the market. And all of a sudden, its share price just tanked. So I think it's down 23, 24% for the month. Now, the fact is, if you're on the right side of that as a short seller, you're winning every time the price goes down. But surely as soon as that price starts to go down, if it's in the index, the ASX 200 index, every exchange traded fund, every index fund that's got our own James Hardie has got to sell James Hardie, which pushes the price down even further, which means a short seller makes more money, which means ultimately they have to sell some more. So it just keeps on being pushed down.
It's a vicious cycle, isn't it? Absolutely. And also, if they actually shrink to a share price or market cap shrink to a point where they are no longer included in certain index, then it becomes a very material downside risk to that share price, because to get out or to be removed out of index, all the index fund has to sell huge amounts of the liquidity. Sometimes it could be days volume, and they have to do it very quickly. Then that creates a problem. In the case of James Hardie, they just essentially just shrinking. They haven't got out of the index, but still there was a lot of selling pressure.
Yeah, they're not going out of the index. They're just going out of the country. They're just going to America,
that's
right?
Right, that's
so
right.
that's what they're doing.
Yeah.
So that's an interesting place. So what you're saying is that there would be fund managers and others watching when, say, for example, you're going to get Standard & Poor's, S&P or whomever, Dow Jones, they're going to change the indices in Australia. So it might be top 200, you drop in, you drop out, whatever it might be. There'd be a guessing game on who goes in and who goes out, wouldn't there?
Absolutely, absolutely. Actually, there's a lot of fund managers or trading houses that focus just on that, because there's a lot of return to be made from, index inclusion and exclusion. So sometimes in the double digit in terms of return, if you get it right. So now, normally there's a formula, but for some reason, there's a lot of variation because S&P actually changing their method, whether 6-month trading or 3-month trading. So there's been a lot of confusion about that. So that's why you have a lot of unnecessary volatility, if you like, around those announcements.
So you told us a month ago that you thought that some of those housing-related stocks, and we mentioned a few of those in the introduction, would be some of those that maybe are the cyclical stocks that in the longer term will get advantage as the housing market starts to pick up again. There's real signs that the housing market is starting to pick up. Do you still get a sense that some of those stocks, Harvey Norman on Friday was very, very strong, for example. Do you get a sense that some of these stocks have still got something to run?
Absolutely. Every one of them has reported green shoots, if not already strong operating position. And then they already talked to very strong trading condition. Harvey Norman talked to very strong trading condition. JB Hi-Fi came through. Even Adair, who had a profit warning 2 months ago, now came through with very trading, strong trading updates. So, we see everything to do with housing is doing better. REA came through, saying very strong volume. Home builder Stockland, we have Gemline.
Stockland was one of the best for the month,
strong.
right up 12.5%.
Absolutely. So they all doing really, really strongly. So, we think that the cyclical play, that your retailers, your housing-related retailer, your home builders is going to have another very, very strong 12 months.
All right, so what was your best trade for the month? Come on, what was your best trade? Give us a little hint.
Oh, look, the best trade. So, our best stock outperformance is clearly from the likes of the Life 360. Not only had a great result, it continued to run on with it, but we had a couple of one. There's one actually little company that's not so well known. It's called Qantas. It's a payments-related business, and it has reported.
It's the old credit union business, right?
That's right.
Yeah.
But they're the digital, more into the more digital back end. So, every digital pay transaction that go through, they get a clip the ticket, and they just been riding that whole digitization or payment sort of wave. Share price went up as much as 20%. It's just been an incredible performer.
That's going to help your performance for the month, doesn't it?
Absolutely. Had a great month.
June Bailey, always great to chat to you. Many thanks for your time.
Thank you.
So one of the themes in this reporting season clearly is the return of the shopper. As June Bailey said, some retailers, JB Hi-Fi, Harvey Norman, Adair, did better than expected. Also, Coles shares soared after its results showed it's gaining even more market share from its larger rival Woolworths. Now, on a normalised basis, Coles supermarket revenue was ahead 9%, and that shows Coles is taking market share from Woolworths. And that's something that Woolies Chief Executive Amanda Bardwell struggled to explain this week.
What we've been focused on is making sure that we provide lower prices for our customers. We're focused on building customer trust.
But that's not the answer to the question.
We're focused on building customer trust, which takes time.
I get that, but why are the customers moving with their feet to an opposing supermarket? You're telling us about what they want, but why is it that they're moving? Is it because they perceive Woolworths to be a higher priced supermarket?
Based on all the customer tracking that we're doing, we're seeing positive feedback from our customers that we've lowered shelf prices, and they're valuing that. But it's going to take time to completely rebuild customer trust.
Now, the curious part of all this is the stats show that Woolworths cut its average prices over the past year, while Coles increased its average prices by 1.2%, excluding tobacco. Yet Coles still managed to increase its sales faster than Woolworths, and that's the clear sign that customers are moving with their feet. Well, earlier this week, I spoke with Coles Chief Executive, Leah Weckert.
The sales result that we've reported today really is a result of a number of initiatives that we have rolled out over the last couple of years. In particular, we have been investing in value and price for customers, and we've actually dropped the price on another 240 products today. But we've also had a very significant focus on availability. So when customers come in to shop with us, they can actually find all the things on their list. And our automated distribution centres in both Queensland and New South Wales are really helping with this. And then from an online perspective, we opened 2 automated fulfilment centres in Melbourne and Sydney in the last 12 months, and that is really helping to drive our online sales.
So just looking at food price inflation, 1.5% for the year, 1.2% excluding tobacco, that says to me that the COVID bout of inflation has passed through our economy.
Yeah, pleasingly for customers, inflation in our business has been very steady at around that 1.2% excluding tobacco for the whole of the 25 financial year. And we've actually seen now a number of categories that are starting to move into deflation, including in the non-food space like toilet paper and dishwashing. We've also got a couple of meat categories like pork and chicken that are also moving into deflation.
Okay, so then you've got efficiency inside your supermarkets, you've got deflation in food prices, attracting more shoppers through the door. But the real trick here is even your e-commerce sales up by 24%. So those automated distribution centres, a deal you did with Ocado many years ago, is really now starting to pay some dividends.
Yeah, we're really pleased with the performance of the automated customer fulfilment centres. Their performance over the last 12 months has actually been ahead of our overall e-commerce rate, so the growth has been higher, and that's really driven by the proposition that customers are seeing. So there's more range to choose from. The products that you get last longer in your fridge, and you very rarely have a missing item from your order, and you put all that together and it's something that's very strong in the market.
So, Lee, I did a little calculation. You'd have seen, of course, the productivity roundtable the government had last week, and the Productivity Commission's idea that there should be a 5% tax on net cash flow. Now, I worked it out for you today. Your free cash flow, $2.93 billion, would mean you would have paid $147 million in extra tax. That's about 13% of the net profit of Coles in the last financial year. Is this a good idea for supermarkets or not?
So I think we would have a view that any conversation around improving productivity in Australia is a good and positive conversation to be having. But we don't believe that we're going to see improvements on productivity by taxing businesses more, whether that's small, medium or large businesses, because large businesses actually disproportionately drive a lot of the productivity gains that we see as a nation. And so we would like to see incentives in place to actually see more investment into areas like innovation, technology and skills growth. And we think that that is the key to seeing productivity going forward.
Because there's a reality here, just like GST when it was introduced. If you get whacked with an extra tax of $150 million, you inevitably have to pass that on to consumers, and they're the ones that ultimately have to pay the price.
It's a real impact to our business if it was to come in, and it would likely mean that we could invest less in the customer proposition and actually in productivity initiatives that we have invested in the last couple of years, like the automated distribution centres that we've opened in the last 24 months.
So just tell me, the view, the mood of your consumer right now, of your customers, is it improving to your sense? I mean, there was a real cost of living crisis going back 18 months or so ago. Is that starting to lift to your sense?
So cost of living is definitely still on the majority of Australian households' minds. But I think what's very pleasing is in our latest surveys, we've seen the first green shoots that sentiment might be starting to turn, which means that with things like the interest rate cut, customers are feeling a bit more confident about their budget going forward, and perhaps feeling a little bit more confident at spending on goods. And I think the food spend that we saw come through from the ABS for June at 6.3% is indicative of that customer starting to feel more confident. Time will tell, though, on how long it actually takes to drive changes in the behaviours that we've seen over the last couple of years, like shopping at more retailers and trading down to more affordable products.
I'll tell you what, Leah Wicker, good to chat to you today and many thanks for your time.
Thanks, Ross. Appreciate it.
Now, one organisation that is acutely aware of change is the nation's postal and delivery service, Australia Post. For years, it's been battling the decline of its letters service and has become more heavily reliant on its parcel services, including Star Trek Express, to bolster its business and also its revenues. Alarmingly, two things happened this week that raise questions about Australia Post in the future. For the federal government and for the Communications Minister, Annika Wells, key decisions probably need to be made. The first shock this week came as Australia Post suspended the delivery of small parcels to America worth less than $800 US. Now, this is because of Donald Trump's decision to hit all imports with tariffs, not just those worth more than $800. This directly and immediately impacts thousands of small businesses that use Australia Post to access the US market. The second point came from Australia Post results. It produced a profit of $18.8 million pre-tax compared with a loss last year of $88 million. Its parcel revenue, though, $7.6 billion, was up almost 3%. And this is despite a spate of new global e-commerce platforms in Australia that drive up competition and drive prices down. Well, the Group Chief Executive of Australia Post is Paul Graham, who joins me now. Paul, always great to chat to you. Can I just start with the whole issue of exporting goods to the United States worth less than $800 US? Can you explain why you had to put a hold on those deliveries right now?
Yeah, thank you, Ross, and good to chat to you. Look, it was a difficult decision that we had to make, along with literally hundreds of other postal operators around the world. This was supposed to be implemented in 2027, so we thought, as did other operators, that we had plenty of time, but then it was brought forward and we had to make a decision on fairly short notice because we were convinced at this time that would be implemented. If we hadn't made that decision, that would have meant that products would have been shipped to the US and then the duties and taxes would have been applied, which may have been a financial surprise for our customers who are shipping and a difficult situation and complex situation for that money to be recovered from them or indeed from their customers in the US. So we had to make the call along with many other postal operators. We've made that call. We still have a commercial product that allows customers to get their products to the US that bypasses the traditional postal channels. We've had that in place for many years. But yes, that traditional postal to postal channel is the one that we've suspended. We're now working around the clock to implement a solution with Zonos, one of the approved providers of technology by the US government that will allow us to calculate the duties and taxes and recover that money before those goods are shipped to the US.
Because as far as I understand it, you can either pay the duty here in Australia or you pay it at the other end, the tariff at the other end, the person who's picking it up. But the question about when it's paid and therefore who has the obligation to pay it, that becomes a part of the dilemma that you had to work out as a postal service.
That's exactly right. And it depends on the terms of sale that the retailer has with the end user as to who pays. The bottom line is someone has to pay under these new rules. And as you mentioned in your introduction, previously anything under $800 US was not subject to tariffs and taxes. So incredibly complex process to implement a new solution that covers every tariff and tax in the US and making sure that those are calculated correctly. And then there's a recovery mechanism in that money then gets paid to the US government.
Well, in your results out late this week, you also talked about the competition that is out there. Now, we spoke earlier in the week with FedEx, who said it already has a solution to get goods into the United States with the tariffs paid. I presume DHL would be similar. They said they'd had experience having dealt with goods out of China and Hong Kong in the past. So I'm just wondering, with the amount of competition that's already out there, are you worried about you losing business clients right now as a result of this decision?
Yeah, look, we're always worried about when disruption hits our customers and what that would mean to ensuring those customers stay with us. We do have, as I said, a product similar to what FedEx and DHL have, a purely commercial product that bypasses the traditional postal channels. But like DHL and FedEx, it is more expensive. And obviously, when our customers are looking to pay duties and taxes for the first time on top of what would be a more expensive solution, that's a difficult decision. That's why our focus is on developing the technology that will allow us to implement the recovery of those duties and taxes in our traditional mail network, which we can do at a more economic price.
What's the feedback been like this week?
Look, it's been challenging for our customers, and we respect that, and we would prefer not to have made that decision. We would have preferred to have more time to work with them and implementing the right solutions. But we're no different from every other postal jurisdiction, every other government around the world. This has come on fast and furious. As I say, originally it was planned to come into place in 2027, but the gateposts were moved, and we had to react to that. We are working feverishly to implement this solution, and I'm hopeful it'll be a matter of weeks, not months, before we'll be able to go back to those customers and say, we can go back to the traditional postal channels, and we've got a solution that allows you to know in comfort what you're paying up front, that those duties and taxes will be collected, and that you can sell in confidence to the US market.
Okay, so if I'm a small exporter, I've got some products, and the US is a big market. It's obviously, with the Aussie dollar relatively low, I've got a bit of an advantage there. What's your advice to me right now? Do I go to your commercial service to try and get my goods into the States until this solution does come along? And I presume it's some sort of a software/payments type system that you're going to try and develop.
Correct, yeah. The system itself will be, when you log on to book a parcel to the US, it will ask you for the description of those goods. It will ask you for the value of those goods. The system will then automatically calculate duties and taxes. It will bill whoever is responsible for those depending on the terms of sale, and then that money will be collected and delivered into the US Treasury. But for those customers that have an ongoing need to make sure they are shipping regularly to the US, we would suggest the use of our commercial product to do that, because that sustains that service to those customers. Or if they can, to look at holding back on selling to that market for a period of time, but that's incredibly difficult. So the short-term fix, use the commercial product that we have available and others, as you mentioned, whilst we are working night and day to implement the long-term solution that will then enable them to come back to our more traditional US export product.
So from your results this week, there are a few other things, and parcels becomes a big feature of this. You're now facing more competition in Australia in that parcels delivery service. Yet it is your parcel delivery service that you and I have spoken about many times before that helps to prop up the letters delivery service, which is declining at a rapid rate. If you've got more pressure on the parcels business and you're not as profitable in the future as you are right now, does that again raise viability questions about Australia Post overall?
Look, we're in a difficult situation, not different to many other postal operators who we've seen go to government and not perform financially well, and therefore given funding from governments to either pay for their community service obligations or indeed to prop them up financially. We are not in that situation. We do not take any money from government. We are completely self-sufficient financially, and we want to maintain that self-sufficiency. But what we're going to have to do is continue to evolve and modernise our business and work with our stakeholders, be it union partners, be it the government, be it customers, be it community, to ensure that we are evolving in a way that allows us to remain competitive in that highly competitive parcel business. But balancing that, Ross, and you and I have spoken about it before, with those community obligations that we have, particularly in rural and remote Australia, around our post office network, around the services we deliver into those communities. They're essential service and ones that we take very, very seriously and want to continue to sustain. So it's striking a balance, but we believe we have a pathway forward. The small profit we indicated that we've produced for last year shows that our plan is working, our strategy is working, but we're going to need more support. We're going to need more support. Our goal is to build the best alternative to the platform players for the Australian retailers so they can compete on price, they can compete on service, and they can compete on flexibility. So you'll see us doubling down on parcel lockers, on new products and new services that allow them to be competitive against, as you say, the onslaught of the global platform players.
Paul Graham, Chief Executive of Australia Post, who again saw an 11.7% decline in letters volumes had it not been for the federal election. Paul, always good to chat to you, and many thanks for your time today.
Thanks, Russ. All the best.
Well, coming up after the break, in the past few weeks, Qantas has taken delivery of its first Airbus A321 aircraft. Well, after the break, I climb on board and speak with the Qantas Chief Executive, Vanessa Hudson, on profit and reputation. Thanks for being with us here on Business Weekend. Well, Qantas shares initially soared in response to its second biggest record profit. The company has recovered to the point that it resumed paying shareholders fully franked dividends, having worked through the giant COVID losses that it made. But the issue of reputation is still, well, it's a delicate dance for our national carrier. Passengers seem to have overcome their anger at cancelled flights, late arrivals and lost bags. They're back travelling at near record numbers, and their bags in the main are also arriving on time. But reputation is more than that, and the recent federal court decision to impose a record $90 million penalty on the airline for illegally sacking more than 1,800 workers came just before this week's profit result. So I spoke with Chief Executive Vanessa Hudson on board one of Qantas's brand new Airbus A321 long-haul aircraft just to get the explanation about profit and reputation.
Well, I think the number one focus that we've got at Qantas is rebuilding that trust, that reputation with our customers and our people. And we have been doing it, but we are definitely not finished with that journey. And a number of things that over the last 12 months that we've been focused on is delivering in the moments that matter for our customers. And that's about on-time performance, that's about delivering the service, that's about investing where they value most into lounges, in our digital experience, into our new aircraft. And I think that being on this aircraft is a fantastic moment for us, because this is the renewal of the domestic Qantas narrow-body fleet that will then be followed with Project Sunrise. And our employees as well, we've actually seen customer satisfaction increase across Qantas and Jetstar for all of our airlines, actually, domestically and internationally. We've seen an increase in engagement. And when I go around and I speak to our customers and I speak to our people, what they say to me is that we're seeing a difference, we're feeling a difference, but the job is not done. And honestly, Ross, the job is never done. Yeah. And we're never, ever going to feel entitled to have customer loyalty. We've got to earn that every day. And if we live that as our mission, I believe that we've got such an exciting future to continue to innovate, to continue to improve from here.
Isn't it interesting, though, you think about decisions such as that led to the federal court, the sacking of the 1,800 people. That's almost a split-second decision that is made inside an organisation. It's not something you can contemplate for weeks, months or whatever it might be. Often it comes down to, we do this or don't we do this? In hindsight, Qantas admits that was a poor decision. So the next time you reach that moment, how do you ensure that you don't make a similarly poor decision?
Well, look, we operate in an incredibly complex and hard environment. We've actually just made a really hard decision. We've closed an airline in Asia, Jetstar Asia. There were hundreds of people that were affected by that, and that was not an easy decision to make. But, you know, when we actually looked at that operation, the costs were becoming unviable. The competitive environment meant that we couldn't generate the return that enabled us to not just see a profit, but to continue to return to give a return on the assets that were deployed in Singapore. And so in the context of that decision, we reflected really hard on, is it the right decision, but also in making that decision, how do we care for our people? And we actually did that, not just care for our people, but care for our customers. So going forward, making sure that you've got always that sense of balance in when you make hard decisions, because there will be hard decisions to make in the future, that you bring into context the customer, the people, the business, and ultimately, you know, the focus of the business going forward and the viability going forward is incredibly important. Costs and cost management is incredibly important in aviation. We know how things can swing, whether it be geopolitics, economic cycles, and making sure you've got the discipline through the cycle is really important. Okay, so customers though, clearly Qantas customers, are voting with their feet because you've got near record profits, you've got revenues and the number of seats that you're travelling at record levels. So that means that the customer clearly is either got the trust or is regaining their trust in Qantas, the brand, and Qantas, the airline. Look, I speak to a lot of customers, and so in answering that question, what I say is, you know, customers say to me, you know, there are things that really I value about Qantas. I value the network, I value the frequency, I value the lounges, I value your people. And a lot of what they say is, you know, comes down to on the ground in the moment that matters, our people and the investments that we've made over many years is really deeply appreciated by customers. But customers want to see and hear from us that we are learning from the mistakes of our past, and that is a really important thing that I say and have said with regard to the cyber breach and also the reflections from the ground handling. But going forward, we are going to make sure that we deliver on the fundamental promise is that I get away on time. If there is a disruption, I understand disruptions happen, but make sure that you communicate to me quickly and properly and get me on the ways as soon as I can. And so we're investing in our digital systems to be able to do that. But the most important thing in terms of our future going forward is the new fleet that's coming.
Yes.
These new aircraft are next generation. They will unlock new routes. They deliver a new level of experience. They've got bigger bins, they're quieter aircraft, they're more efficient, they fly further. And we've seen, as a proof point, that the Jetstar, who have got 20 of these next generation aircraft, it delivers across that scorecard. Customer satisfaction's up, employee satisfaction with the new aircraft is up. Results, and the financial performance of these aircraft are delivering the results. So that's a win-win-win.
So when do you expect the first of the Project Sunrise aircraft to go from the east coast of Australia, Melbourne, Sydney, into New York and or London? How far is that off?
Well, it's really exciting actually. In October, the first aircraft enters the final assembly line, so it will be real. We'll be able to see it. That aircraft arrives at the end of next year, and we need 3 aircraft to be able to do a daily service to either London or New York, which we haven't decided on that yet, and so that's going to be flying commercially in the first quarter of 2027. And when we actually, I speak to a lot of corporates, I speak to a lot of customers, I'm getting so much excitement about, I can't wait to see it and I can't wait to fly on it.
I want to go to your shareholders. There was a big jump in the Qantas share price this week. In fact, before then, even Qantas shares were up 75% in the past year. So clearly shareholders feel as though they're getting something from what are near record profits from Qantas. Then you've resumed dividends as well. So this means that really all of those COVID years of disruption and so forth, from the shareholders, the employees and the passengers' point of view, seem to be in the rear window for you.
Well, getting the balance right, and shareholders expect that we get the balance right, because that is about us making sure that we look after our customers, we look after our people, we look after the financial part of our business. That then enables us to reward our shareholders, and that they are an important part of getting the balance right. And being able to reintroduce fully franked dividends is a fantastic place to be, and it gives our shareholders a sense that we are confident in not just the business of where it is now, but we are confident in the business going forward. And that is good for everyone, because investing in these new aircraft is what comes from being profitable and having a strong balance sheet and having strong profitability. But that is actually also going to unlock earnings growth itself, because, as we said, these aircraft are amazing and we'll be able to do more with them.
So, okay, just one last one for you. You've gone through all the reputational issues. This is a high-stress environment that you have entered into as a chief executive. Is this a good job?
I love this job. I'm not saying that this job doesn't have hard days. Of course it does. Any CEO job does. But I love the people in this organisation. I love what we do in terms of being a national carrier, but also flying our customers to domestically, regionally, internationally. It's an incredibly exciting business, and to have the portfolio that we do, with the Jetstar brand, with the Qantas brand, with the loyalty brand, but with the people and the passion that exists in this company, it's infectious, and I wouldn't be anywhere else.
Vanessa Artson, thanks for your time.
Thanks, Ross.
Appreciate it very much. Well, coming up, an urgent effort to make private health insurance more accessible, even desirable for young people, seems to have paid off. After the break, Edward Boyd speaks with Medibank Private Chief Executive David Koskar. Thanks for being with us here on Business Weekend. Well, any form of insurance is kind of a little like bookmaking. The bigger the book, the pool if you like, the stronger the house is. And the pool needs a broad spread of risk. Health insurance is a classic example of all this. Older members are those most likely to make claims, so more younger people are needed in the pool to make it robust, to actually succeed. The dilemma for the industry for decades has been to attract more younger people into health insurance. But if they don't think they'll make a claim, or if the public system suits their needs just fine, well, they stay away. This week, Medibank said revenue grew 6.4% last year. Underlying profit 8.5% higher at $618 million. It paid out $6.6 billion in claims. And Edward Boyd caught up with Medibank's Chief Executive, David Koskar.
Well, it's been a good result. We've seen that reflect in our numbers. We've seen strong momentum in our resident business, really strong growth in our non-resident business, and pleasingly, very standout result in Medibank Health with a 27% increase in operating profit. I think it's come through investing and looking after our customers, investing in their health and well-being and helping them save out-of-pocket costs. It's come from being disciplined in how and where we grow. It's also pleasing to see the momentum in the second half that really sets us up well for FY26. So overall, a good result. And pleasingly, the market in insurance remains buoyant. We've seen record numbers join health insurance and a very strong growth in under 30s, the largest growth in 13 years. So I think all the numbers are looking pretty good. But we continue to do what we can to support our customers and to think about investing in the long run.
Yeah, non-resident policyholder growth was twice as strong, basically, as resident growth. Just explain the significance of migration and international students for policy growth at Medibank.
Well, the non-resident business is made up of students, workers and visitors, and we know that international student numbers are a really critical part of the economy, 3 to 5% of GDP. We've been growing share in that market, and with the most recent announcement by the government of more student visas for FY26, we're pretty excited about the growth prospects in that market. We're also been investing in growing share in the workers market and to some degree investing in the visitors market, although we think our share growth will come probably more in 27. But with 4 out of 10 students becoming residents and 7 out of 10 workers becoming residents, it's not just the business that we're growing today in that area, but it's also how it helps us grow our resident business in the future, which puts us at a competitive advantage versus others in the market who don't play as strongly, in that non-resident part of the market.
All right, more broadly, looking at Australia's health system, how much pressure is it under at the moment? Is demand for health services outpacing supply?
Well, there's certainly health demand is very strong and on the up. We're getting older, and unfortunately, we're getting a bit sicker. And so, when you look forward, the demand in both the private and the public sector for health services is growing. But we can do a much better job at meeting the needs of that growing demand in different ways. We call it the health transition. Really, the future of health in the next 10 years is going to be in the home and the community, and less healthcare will be done in acute, long-stay hospitals. There'll be more emphasis on prevention rather than treatment. And we need to adopt the latest technology and AI to be part of the care team, because if we don't do that, we just simply won't be able to support the health needs of the community. So at Medibank, we're very proud that we're investing probably half the private health insurance industry's investment in prevention, even though we're only 26% or 27% share of the market. We've seen the doubling of our members enrol in prevention programs. We're very excited by the prospects in primary care. We're looking to triple our size in the primary care sector, where we bring together not just our GP business, but also our other allied health and nursing business together to really get ahead of that curve and support patients to either prevent disease or support them earlier on in their healthcare treatment. So I think healthcare demand is growing, but the way that we need to meet that need needs reform, and the settings of the past, won't support us in the future. So we all need to work together to help ensure that Australia's health system remains one of the best in the world.
Yeah, well, the federal government held an economic reform roundtable in Canberra earlier this month. I mean, what are the policy changes you might want to see to really help the healthcare sector in Australia?
Well, I actually participated in the health forum a couple of weeks ago, and really there was a lot of conversation about the health transition, the need to move care safely from the hospital setting to the community setting, the need to digitise and invest in technology to support patient and clinician experiences, the need to go upstream, invest in prevention to help improve health today and avoid costs tomorrow. So I think there's lots of reform ideas on the table, and I think the conversation needs to continue. And look, I think what's also very clear is that whilst in other sectors productivity is a numbers game, in health it's about health outcomes. I believe a productive country is a healthy one, and so we need to continue to invest, is what we're doing at Medibank, in prevention and in the health of our members, and that's the secret to long-term productivity as a country.
Private hospitals have been lobbying to get insurers to contribute more funds to the health system. I mean, how much of your private hospital costs been going up over the past 12 months, and what's the outlook like for FY26 when it comes to private hospital costs?
Well, private hospital costs are about 48% of our claims costs. And yes, we have been paying more to hospitals as their costs increase. But equally, there are other deflationary areas of our claims line that means our overall claims experience has been quite benign. We are seeing potentially some slight increases in the claims expectations for next year. But I think when we invest in prevention, when we're investing in personalised care models and our partnership agreements with hospitals we're investing double what we did last year than the year prior, all of this will help us maintain affordability and maintain claims at a level that enables us to keep premiums as low as they can be, so we can have as many people in private health as we can to take pressure off the public system.
We've also had 3 interest rate cuts this year from the Reserve Bank. I mean, how would you rate the strength of Australia's economy right now?
Well, the economic conditions are, in the world stage, doing pretty well, but there's certainly some things we need to work on as a country. I mean, I think the households are still under pressure, and we need to think about the settings for today that are going to help us set up for tomorrow. I think there's active conversations going on, but I think we come from a position of relative strength. But we know changes are needed to sustain both our wealth and our health. We're very focused, as I said before, on investing in things like prevention, on health outcomes. What needs to be funded is quality health, and unfortunately today that is not what is funded. And so everything we need to be doing and investing in is all about maintaining outcomes so we're a productive country, so we can sustain our lifestyle for future generations.
David Koczkar, Chief Executive Medibank. Great to have you on the show.
Thanks for having me.
And that's it for the program this Sunday. Up next, all the latest news right here on Sky News. Business Weekend returns next Sunday, but of course you can keep up to date with all the latest business news with our daily program, Business Now, 4:30 p.m. Eastern Time, and via our website, skynews.com.au. Thanks for your company. I'm Ross Greenwood. We'll see you next week.